Tech Rounds today. I'm talking of no other person than Mark Kleyner. Mark Kleyner is the co-founder of Dream VC, a very a well-known venture capital platform who is supporting the African startup ecosystem. And we will be talking about the African startup funding landscape, the trends, the shifts, and what's changed so far. And of course, when you talk about the funding for startups, it's a very, very important and critical topic. And that's why you don't have to miss this one. So if you have a founder, friend, an entrepreneur who is out there, so share the link and let's all join the conversation. Hello, Mark. How are you doing? Good to have you on the platform today.
Hello, Emmanuel. Thank you for having me on the platform. I'm doing very well and I'm excited for the conversation.
All right. Yeah, of course, I'm excited too. So, just going in quick, just a quick spotlight before Mark actually tells us who he is in the ecosystem. So, Mark, like I said earlier, is the co-founder of Dream VC, an African-focused investor accelerator. So, under his leadership, Dream VC has catalyzed the creation of numerous funds, even as Dream VC fellows have gone on to join over 60 funds. So they've launched the 4X Angel networks and established multiple syndicates. Collectively, these initiatives now manage $6.6 billion, driving growth in emerging markets. That's a huge one. So that's to show you the caliber of guests that we have here on Tech Rounds today. So I'll leave the floor now for us to hear from the horse's mouth, so to say. So Mark, over to you.
Absolutely. And I think you've definitely done me credit with a strong introduction there. Had to follow up from that, Emmanuel. I think beyond that, all I will say is today I am joining the room from the UK. I'm usually based between the UK and various parts of the continent, and I travel actively across Africa for about 6 to 7 months of the year. Currently, as mentioned, I run the Investor Accelerator and Venture Institute known as Dream VC. I'm one of the co-founders and I'm the co-CEO, where we teach individuals how to break into venture capital. We upskill existing investment professionals all across the continent, and we help corporate professionals to understand how can they bring their corporation into investing into startups all across Africa. Outside of Dream VC, I also have a few hats as an angel investor, a fund advisor, and a board member. And I currently do my bit in supporting the ecosystem through a range of other initiatives on the side. But yeah, that's pretty much all about me. But I would love to get into the conversation. So excited what you have in store for me.
All right, thank you very much. That was very brief, and then I doubt no one would not know what I'm actually. You welcome Mark to this session. So, in this compelling session on Tech Round, we're going to explore the evolving dynamics of the venture capital landscape in emerging markets, especially the African tech ecosystem. So, our discussion would pivot around the recent global financial shifts, their impact on African tech ventures, and the silver lining that signal the resilient and adaptive future for startups and investors alike. And yes, that's why this session is for both the startups and the investors, because we are going to look at how they will have an interplay and grow the ecosystem. So we're going to look at the impacts of the global financial crisis. Like I've said, we'll look at the say affected the African tech ecosystem, and the exuberance and market correction. So when we have this financial crisis, it resulted in some form of amounts they're raising, and also we will look at the shift in the investor landscape, and that's how our conversation is going to revolve. Mark, are you ready for this? We're starting this already.
Let's go.
All right, all right. So, yeah, we've gotten to know you. So, can you explain what venture capital is all about in simple terms?
Well, I should hope so. I mean, that is our day to day. But let me give it a crack. So, what I'd say is to understand venture capital, especially for those of our listeners who perhaps don't come from the investment space, you need to take a step back and understand very quickly what is a startup, because that's critical to the understanding of what is a VC. A startup is not just like any SME. An SME is usually building, or small medium enterprise is building with an established business model, something that is perhaps incrementally innovative. It's not changing the world, but it's helping people, right? A new laundromat, a new bakery, a new fast food restaurant. It has an established business model. It's making profit from day one. And the way that that type of business will grow is by saving up money from its profits and then opening up a second branch or a third branch, franchising or taking out loans, for example. In comparison, a startup is a completely different type of business. And startup is often building in an unproven environment. It's building a product that has no verification of success, no likelihood necessarily that people will definitely go ahead and buy their service or the product that they have. As a result, many of these startups actually have a disruptive business model. They're trying to completely change the way we experience transport, as with Uber, the way we experience accommodation, as with Airbnb, the way we experience payments, as with Flutterwave. And for such businesses, they invest a lot of money into the research and development necessary to actually build out their product right from the beginning. So they're investing a lot of money, but they're not making a lot of money from the beginning. That means that most startups are actually loss making. They lose money for the first few years. And for a startup to exist while they're losing money, someone needs to be financing that experimenting. Someone needs to be financing that early growth. That's where venture capital comes in. Venture capital is the earliest stage of risk financing, where essentially professional investors, often with great founder networks, will assess these ideas, the disruptive ones that may yet change the world, that are investing a lot into research now, so that maybe later they can be a huge business, and will extend to these people an investment so that they can cover their costs, they can grow that business, they can prove if this disruptive idea can actually work in exchange for ownership in the company.
Awesome. All right. Thank you very much. Thank you very much for throwing more light. I believe everyone joining this session should have a real understanding of what venture capital is actually all about. So, moving deeper into this conversation, you've given us a clear description of what venture capital is all about. So, uh, can you go further to briefly give us the how it differs from the different types of investment? I know that we have buying stocks or investing in mutual funds. So, how does venture capital differ from these other forms of investment?
Yeah, absolutely. It's a good question. I would caveat that there's also, other types of investing beyond that. We have, crypto and real estate and art if you really fancy that. But I think stocks and mutual funds are a good comparison point, because I think for many of our listeners, perhaps when you think of investing, you think of calling up your broker or going up on your investment app and then putting a few dollars towards buying maybe 1/10 of a share of Facebook, right? That's what investing means to a day-to-day person. But venture capital investing is quite different. So when we talk about buying stocks in general, when you mention it, for example, just now, I'm sure you're actually talking about buying stocks of publicly traded companies. That's less than 1% of all companies out there. You can buy shares, very small shares, a very small percentage of ownership in the company, and you have no direction or no ability to influence the direction of that entity. You get money then from selling those shares or from getting a share of the profits they make every single year. That's essentially a form of passive investing. You're investing in stocks because you don't necessarily want to control that company at a public level. Now, that's what buying stocks means to most people. Mutual funds take that a step further. So maybe instead of just buying a couple of shares yourself, you might choose to instead go and give somebody else money to actually invest in a range of public stocks. That's what a mutual fund does. They say, well, look at some of the biggest pharmaceutical companies out there, the biggest oil companies out there, the biggest banks out there. How about we invest a little bit into each one? And then your $100 can give you exposure to a couple of these. Again, the way you make money is by buying or selling these shares quickly between you and any other individual that wants to buy your shares of you, and then by getting a share of profits. But again, you have no direction on what the business actually does. If the business does well, it doesn't do well because of you. If it does badly, it doesn't do badly because of you. Now, that's the difference with VC. Fundamentally, it's the risk reward component, the involvement component, and the time dimension. When we talk about risk and reward, venture capitalists are investing in the earliest stages of businesses. These businesses might take 10 years, for example, before they ever become public and are available to the rest of the world. That means that as a private business, not just anybody knows about the startup. In fact, most of the world, 99% of us, don't even know that this business exists. But it could be, for example, already profitable, highly successful, and the next Uber story or the next Alibaba, right? That's what venture capitalists are looking for. So we're investing super early into businesses that potentially might grow 1,000 times over and become super successful. as compared to these public entities, which are already so big that it's difficult to imagine that they will grow even 10 or 100 times larger than they already are. Secondly, when private companies are still private, any shareholder that buys into these companies actually has a bigger influence on the way that the company is run. So, for example, I invest individually or through a venture capital fund into a startup, I can actually influence who they might hire. I can influence which markets they could expand into. I could influence how they actually run the company. So the ability to influence the investments that you actually have is much, much higher if you're investing in earlier stage companies where your money goes further and your ability to influence them is therefore stronger. Finally, there's the time dimension. When I invest into a share of Uber or Microsoft or perhaps Facebook, which are now public companies, I can potentially buy that share today and sell that share tomorrow. But realistically, for private companies, for startups, if I invest in it today, maybe the earliest point at which I can be able to sell my shares is 2, 3, 5, 10 years down the line. So we are taking essentially a gamble and thinking that this business has a much, much higher potential reward, but I will only see that potential after a couple of years. So my biggest and easiest analogy to think about this is, buying a stock is almost like going to a
Yeah.
supermarket. You're buying something you can see straight away,
Awesome.
but buying into private startups is like buying real estate. You're buying something that's in the long term and may potentially be a much better investment.
Yeah. Thank you very much. Thank you very much for making a clear distinction between these various forms of investment. And yeah, this is really getting interesting. And I think we are going deeper into when we get to learn more and understand how the funding ecosystem works. And just like we were having this conversation, we have some few reactions on social media so far. We have Benga Adeyemi says, interesting insight thus far, especially the VC definition. So that's to you, Mark. Okay, I think that your insight on the VC, the definition of what venture capital is all about, was really, really, like I said, and Benga really loves that. So, taking this further though, we know we have different series when we have to funding. There are phases for startups. You see, someone says they moved from maybe the bootstrapping phase when they had to like fund themselves by themselves or around friends and family and stuff, up to Series A, Series B, and Series C. So, how do expectations and the stake change at each state of these funding phases?
Yeah, thank you for mentioning it. You're right, actually. So, funding usually starts from a stage of bootstrapping. The term bootstrapping actually refers to the idea that you're surviving off everything that you can fit in the back of your car, in your boot. So, the idea is that you're strapping the success of the company basically on what you can hold on your back. Once you get further past that stage, you've built out your idea, maybe you've created your first product, you have some idea of who you're going to test it with. Usually, you have a angel round where high net worth individuals, maybe family members, maybe long distance colleagues, your boss, or somebody in your network says, okay, I think what you're building might be successful, but I understand that it's super high risk. So I will get a big portion of shares in your company in exchange for giving you some money to experiment. Once you get past that stage, you get into seed stage, and seed is really pre-seed or seed is really where the first institutionals or the first professional investors, such as venture capitalists or even family offices, might invest in your startup. They will come in, they will standardize your growth strategy, they will help you think about how you scale your business from the first 1,000 customers to the next 10 million, and they will really, really be, usually, in the ideal case, on your side, helping you create that business with informative advice, consulting, and guidance, even as they provide you with the capital to actually scale. Now, the biggest difference between perhaps that initial phase when you're bootstrapping, the seed stage when you get your first institutional investors, Series A, Series B, and Series C, is the level of responsibility you have for other people's money. When you're bootstrapping, when you're building out of your house, when you're building out of a co working space, when you're building out of your university, you're only responsible to yourself and your team, potentially also to society, depending on how perhaps magnanimous you feel. But as you get to the point where you start to accept external investment, especially if that external investment comes not just from one individual, but dozens of individuals or even firms that themselves have a mandate, you start to be legally and financially responsible for that money. They're giving you that money because they believe genuinely that you can actually succeed in this idea. So then your failure is no longer just an option that doesn't hurt anyone. Your failure will actually hurt people, customers, vendors, and these investors if you don't succeed. So essentially, that level of responsibility keeps climbing and climbing and climbing. In fact, that level of responsibility even has a term. It's called essentially company governance. And usually, as you scale to the point of Series A, your investors will come in and say, well, look, at this point, you're already starting to be a serious business. You're usually expanding outside of your home city, for example, from Lagos all across Nigeria. You're expanding maybe even across borders to other countries. So you should be a responsible executive. If you don't have responsible executives on your team, you should be hiring responsible managers. If you don't have a board of directors, you should be setting up a board of directors. And you should be thinking about how are you actually taking society's interest into account when scaling your business. Series B takes that further step, and Series C takes that even further. So the later you are in that progression from bootstrapping, angel, pre-seed, seed, Series A, Series B, Series C, the more responsible you have to be as an executive founder, the more responsible your company has to be on a social level, and often the higher the expectation from investors in terms of the revenue you should be reaching, the scale of sales you should be reaching, and the potential of your growth. I think that's really the biggest change in expectations
All
over
right.
time. In fact, to that end, we recently helped to publish some research on good governance standards for startups,
Wow.
and
Awesome.
we'll be posting about that through JimVC later.
All right. That's amazing. So if I'm able to synthesize from what you've said so far, the different phases of funding actually it grows your responsibility to your startup. Okay, how responsible are you to managing funds over time? So I really love the illustration you gave about bootstrapping, like starting everything from the boot of your car, and then you were moving ahead, and then you're getting to Series C or something. You're being more responsible about the funds you're raising, and then the expectations are also high about how you are utilizing these funds. So it's not a time to go about spending or buying the best cars. Okay, all right. So if you're joining the session, this is Tech Rounds on Tech Build Africa. We do this every time, and we bring up innovators and insightful minds down here in the studio to have this very interesting conversation. So keep it up. Follow us on all social media platforms wherever you're watching this session. Just follow us: Twitter, or now X, Instagram, Facebook, LinkedIn, or YouTube. Just subscribe so you don't miss any of the sessions when we gather here. And then if you're watching this right now, do drop a comment. If you have a question or you have some insights or opinion you want to share on the show, you can actually do that in real time. All right, so let's get back to this conversation. Uh, Mark, over the years, there's been so much excitement about tech funding in Africa, and we noticed that there has been some kind of a shift. We could call that because of some global macroeconomic factors, but you're going to clear on that. So there has been so much excitement back in the year. So what has changed over time?
Well, I think the most important thing to understand is why was there excitement before,
Okay.
where we are today, right? So, why was there excitement before? Well, one, we see a whole new generation of people entering the technology space all across Africa. I remember having several conversations close to 6, 7, 8 years ago where multiple big tech companies that wanted to do business in Africa were saying, well, there's no way we could find enough engineers or good programmers in Nigeria, in Kenya, in South Africa, or anywhere else to actually outsource all our operations there now. Almost nobody is saying that today. Today, a whole host of corporations are outsourcing tech talent to African markets because there are now hundreds of thousands of people who have picked up programming skills and software engineering skills, which is a key determinant, a key factor to create a tech ecosystem all across the continent. That's number one. Number two is we've seen on a government level, governments starting to realize that the technology space could be the next step forward for multiple African economies. Many African economies by nature are extractive. They focus on raw resources, raw, for example, oil and gas, raw timber, raw gold, mining operations. But what we've seen is that many of these governments have been embracing technology as the step towards the knowledge sector. If they can provide incentives on a local level for people to pursue the technology space, to join the technology space, to work in that environment, then maybe through such technology adoption acts or startup acts, it can actually become a major industry. And that's what we're seeing. Great examples of this being, for example, Nigeria, Senegal, and Tunisia, with particular startup acts that actually help to encourage a lot of people to pursue this space. So all of that alongside a global reemergence of the Africa rising narrative, has definitely brought more people into thinking, well, how can we work in Africa and accomplish what India has accomplished in the early 2000s or China in the late 1990s? So that was the exciting part. And the demographics, the core macroeconomics, the core opportunity in investing across Anglophone, Arabophone, Francophone, and Lusophone Africa still very much is the same. That's not changed at all from 3, 4 years ago. In fact, today, all of those opportunities are bigger than ever. What has changed? One major thing. One major thing that changed was we had a global financial recession. And that global financial recession was very unusual. It was not like most of the financial crises we had on a global level for the last 100 something years. It was actually quite unusual because it started with a pandemic. And as a result of the pandemic, it completely changed the dynamic of consumer spending all across
Okay.
the world. A lot of people were spending a lot of money on consumer discretionary products. They were sitting at home, they were spending money, spending government grants or spending the savings they had. And as a result, it drove up prices. We saw an increase in inflation, especially as the price of production rose during COVID. And in return to seeing how the rise of prices was starting to get very punitive at a global level, many central banks around the world said, well, we need to try and hold this rise of prices. Let's raise the interest rate. What has that done? When central banks raise the interest rates, commercial banks, your high street banks, also raise interest rates in return because they're getting their money from the central bank. And when your bank, which you think of as a safe investment, where the money is hypothetically not going to be touched, right? It should be safe at the bank. If you can get a safe return that's now giving you 2, 3, 4 times higher interest rates than it was giving you 2, 3 years ago, why would you invest your money into a high risk asset class like venture capital, when in theory you can get a moderate but guaranteed return in the bank? That's what happened on a global level. The best example I can give of this is I saw several Swiss banks and European banks going from offering 0% interest, which is basically you will not get any money by leaving your money in the bank, to now offering 5% interest in the last few years. That in turn has meant that many big companies, big corporations that might have invested in venture capital are now keeping their money in banks temporarily, at least while interest rates are high. So if they're keeping their money in banks, they're not investing it in venture capital funds, and the venture capital funds themselves don't have money, then those venture capital funds can't transfer that money through to Africa. Now, you might say, well, I'm talking about Europe, I'm talking about the US. Why does this matter? Well, it matters because about 75% of African venture capital funds today get the vast majority of their money from international institutions. They don't get their money from African banks. They don't get their
Don't
money
you
from
think
African
this
state.
is a problem that needs to be addressed? Because we can see when people raise funds and you go to check where they raise the funds from, or the VC that facilitated the fundraising process, you see that most of them are European countries. Is this a concern? Because we're talking about bringing up more African or local investors. Do you think this is a concern at this point?
I don't think it's a concern at this point. I think it's a concern in the longer term.
Okay.
So, in the long term, you need to think about how an economy can be self sustaining. You look at countries like China, you look at countries like Singapore, and the majority of investors in China or in Singapore are Singaporean or Chinese, respectively, right? They are investing in their own economies. You have corporates that are partnering with startups, governments that are partnering with corporates. Everyone has incentives to partner together. And so the majority of funds can raise at least 50% of their funds on a local or regional level. You then take the lens to, for example, a Nigerian or Kenyan VC, and they're going to the US or to Canada or to the UK or to France or to Belgium or to Amsterdam and Netherlands asking for money there. What that does is, on one hand, that's good because if you get your money from abroad and it works out really well, then local institutions say, okay, maybe it's not as risky. Now I can start investing. But in the longer term, that's also bad because if you were a great investor, if you invested in all the big unicorns in Africa today, then you've made that money, but then you've given a good majority of the profits you've made and it's gone abroad. It's left Africa and it might not come back again, right? Maybe that
Yeah.
bank gave several African VCs money 5 years ago, but now it wants to keep that money safe in a Swiss vault. So that money came into the ecosystem and it left. But if it had been keep coming into the African ecosystem, every dollar, every euro could have gone 5 times, across 5 different startups, and that would have been more healthy.
All right. All right. Um, that, but we'll get to that again. So I know that we have a lot of startup founders who are watching these and entrepreneurs or upcoming entrepreneurs, and then there is always a problem about the concept of valuation, because valuation, it's very holistic as to how you see your company, the value and everything. I've been to a couple of startup pitches, and I think we had the Omniverse event few weeks back, few months back, and yeah, we had some pitches there. And of course, just a quick one, the co-convener of the Omniverse events will be on Tech Rounds later in the day, in the week, and we'll have more conversation. So back to what I was trying to say here. Many startups have a problem trying to value their company, especially when you are asked how much are you looking to raise as a startup for this your idea, and you have to see that it really must tally with the valuation of your startup. So at this point, can you help us to know how a startup can determine the valuation for their startups, especially during the fundraising process, and how this is very important for both the startup and the investor, that's the VC here?
Yes, very good question, and a great place to subtly plug that is one of the things that we actually teach at Dream VC, how to actually value early stage businesses, albeit we mostly focus on helping individuals or investors price
Yeah,
them rather than the founders themselves. But that aside, there are a couple of factors that go into valuing a company, and these will evolve even as a company evolves. The way that I would value a very early stage business that doesn't yet have an office, that doesn't have physical assets, and that's building a software out of your parents' basement, as compared to a business that has an office sitting in Yaba and Lagos, building something with an established audience, as compared to yet another sitting in San Francisco with markets all around the world, will be a little bit different. But fundamentally, for early stage startups, it comes back down to the basics. Number one, you start to look at, has this business actually been making sales? Are there sales numbers? And those sales numbers, can they scale? So, what is the value of your revenue? Well, you look at a shop, for example, a typical bakery, and if they sell $1,000 worth of bread today, they will probably sell $1,000 worth of bread tomorrow,
yeah,
maybe plus minus $100. But you look at a startup, and it might sell $1,000 of software today, $10,000 of software from a week from now, and $100,000 of software 10 months from now, right? So that scale is a little bit more exponential, logarithmic of sorts.
yeah,
So you have to consider, where is the revenue of the company today, and how much can it scale, and what is the value of the future potential of the revenue of this company. That's number one. You then look at the customer base. So who is this company actually selling to? When you value a company, you need to consider, are they selling to individuals, in which case their market are individual consumers, and how much can an individual consumer actually spend on an additional expense beyond fuel, beyond bills, beyond everything else? Okay, that's a certain amount. What about businesses? Are they selling to businesses or to governments? How much can they afford to spend if you're actually helping them solve a problem? You then need to price in the technology, the product, or the tech component of what the startup is actually building. Maybe you're building a solar battery, maybe you're building computers, or maybe you're building a software application. There's still an underlying cost to build something similar. And finally, you come down to perhaps intangible factors like the strength of the team, the cohesion of the team, and their ability to actually convert customers. In theory, if you look at two businesses that both have no sales, and you like ask a typical banker, how much would you value these businesses at? They would say, well, zero. They have no physical assets, they have no physical revenue, and they have no physical sales. But a venture capitalist would value them differently. One startup might be formed by someone who has enterprise connections. They were previously the head of Africa for Google, for example. So then when they come knocking at their friends' doors and say, would you spend $5,000 to buy this new software that I've built? Many of them would say, okay, let's sit down and talk. But then someone else, formed by a young student with no connections and no network and no ability to sell, or at least no experience to prove it, will be valued much lower. So really, it comes down to a combination of these tangible factors and intangible factors. And overall, there are about 15 to 16 common venture capital valuation methods that are used in an early stage. But usually, we're trying to price in, what does the startup have today in terms of physical assets, and how much would it cost to replicate? What does the startup have today in terms of intangible assets, like the team, the idea, the opportunity, and how difficult is that to replicate? And what is the future potential of this startup in terms of what it could accomplish
yeah.
if we were to invest in this business? And if you can find a value on all three things, then you have the valuation.
Okay,
Now, coming back to your second question, right, in terms of how that's important to founders or investors, it's a little bit different, right?
all right.
For founders, the valuation is a symbol of success. If you have a higher valuation, you'll be published on Tech Build. You'll be published on tech publications all
Sure.
across the continent. Everybody will be saying you're a big success story because you have validated that people are willing to pay a much higher price to buy shares in your company. It's by proxy a signal of success. It's also an assessment of business value. Let's say you're worth $100 million. You then go to a bank and you say, look, my shares are worth $100 million. And the bank, who then maybe turned you away 5 years ago when you were a worthless startup, now comes and says, well, now that you have this tangible value and investors are willing to pay for it, maybe we can give you a loan. So it's important for startups who need to assess the business value like that. It's also important for assessing the stock. Remember that many startups can't afford to pay you as well as an international company.
Yeah.
You're not going to be paid a Meta salary, or for example, like a Microsoft salary working at a startup. So how do they bring you in if you need to somehow offset the fact that you're taking a lower salary to work for them? You give them shares in the company and you promise them that maybe just one day your shares in the startup will be worth hundreds of thousands of dollars or millions even, in which case, in theory, then it's worth the sacrifice of dropping that corporate career to work on a startup. So for the startup founders and their team, it should be pretty obvious why the valuation is important. And obviously, the higher the valuation, in theory, the better for the startup. I'm saying in theory because there are some nuances. For the venture capitalists, it's also important because for venture capitalists, the valuation is by proxy an assessment of how much money we can make. If the value of the company is too high now, if a company is worth $10 billion today, for us to get 10 times our money back, we need to buy shares at this $10 billion and then sell shares in the company when the entire entity is worth $100 billion. How likely is that to happen? Pretty unlikely, I would say. But if the company is worth, for example, $1 million today, and it has a crazy, amazing idea that will spread all across the continent or somewhere else, then I can tangibly imagine that it could be worth 10 million down the line, or 100 million, or 500 million. So I could very much make 10 times, 50 times, or 1,000 times my money back, right? In which case, for venture capitalists, we usually actually want to see a valuation that's lower, not because we actually care about the assessment of the total business value like that, but because we're interested in the delta, the difference between where it is today and where it can be down the line. So different reasons why it's important, but you could immediately see how for the founder, they might want to push the valuation as high as
All right.
possible. So they sell the minimum amount of ownership and get all the benefits. Meanwhile, for VC, they want to push the valuation as low as possible. So they pay the lowest price when they buy and get the highest value when they sell.
When it
So
goes up.
usually
Yeah.
that's a bit of a market manipulation.
So basically, this is all about strategy. So I think I'm very much concerned about the startups who, especially the ones who are watching this conversation. As a startup, you really need to ensure that. I hope you can see me though. Can you hear me? You can hear me, right?
Yeah, it's all good.
Okay. Yeah. For startups, you've heard what Mark has said. You need to really be able to analyze your people you're selling to, your market, the idea, and the future of your sales, what you're having and how you're going to grow over time. All of these count as to how your startup is being evaluated. Okay. I just looked into the comment section. I see that we have some questions here, so I'll quickly pick this one from Ogenyi Ebinyi. So he says, so Mark, having shares in the big telecommunications company in Nigeria, is it safe? So this is more like an investment concern. So it says, having shares in the big telecommunications company in Nigeria, is it safe?
Hmm. I think it depends on which big telecommunications company you're talking about in Nigeria. Maybe one that starts with M and ends with N. Well, usually telecommunications is a sector that is really, really important. It's considered one of the infrastructure sectors in the sense that a lot of other sectors can only exist if the telecommunications sector is healthy. With that in mind, there's almost always demand for telecoms. There's always demand for signal, there's always demand for networks, there's always demand for the infrastructure to power data transfer. So, in that sense, telecoms is a pretty resilient industry over time. And you've seen across most African countries that telecoms is one of the biggest markets. Nigeria is no exception. In that sense, if you consider safety by the size of a company, yes, some of the biggest telecommunications companies in Nigeria are some of the safer investments in that sense.
Okay.
But usually when you invest, you shouldn't just be thinking about what is potentially least likely to fail. You should be thinking about what can actually bring you
Well,
money back, right?
yeah.
Keeping your money in a vault, in theory, under your house, if no one knows about it, is as safe as possible. No one will ever know about it, but your money will probably rust and probably decompose over time. So maybe not the best idea from investment point of view. So normally you have to think about, am I investing in this company with a clear understanding of how much money I can make on that investment? Can my value of my money at least increase over time? And can there be a substantial increase over time? And realistically, the problem with most public stocks on the Nigerian Stock Exchange is that there aren't actually enough investors, international institutional investors, who like to invest in the Nigerian public market just yet. There are many, but not enough. And as a result, you don't see Nigerian companies that are valued, quite highly and therefore public, actually change too much in the valuation. You might see the shares of Tesla rise 100% tomorrow in the US because there are enough investors to push that demand in that direction. It could also fall 50%, so you could lose a lot of your money at the same time, right?
Yeah.
But for someone like Airtel or Liquid or MTN, you won't see as much variation because the business is more secure. So safe, perhaps. A good investment decision, ask your investment manager.
I think it's always a very, very important to have an investment manager, to someone who gives you some investment advices, and yeah, to go. So I mean, investment is all about the risk. So if you rather risk keeping your money in the house and have locusts eat on them or feed on them, or actually taking out the risks on investing or buying shares in a public outfit or venture, and you should decide that. But then, just like Mark has said, you should do your homework, look at the future projection for the company, look at the kind of things they do, their market, are they really offering value? And then of course you need to look out for the news every time. You can try Yahoo Finance, they're very good with keeping you updated with some of these things. So all right, so let's move ahead with the conversation. Yeah, we're still taking questions though, in case you have any opinion or you want to ask questions or you want some uh Mark to throw more light on any of the stuff we've discussed today, you can always reach out to the comment section, and that's how you join the conversation. So, Mark, how does someone decide if venture capital is the right choice for their startup? Or should I reframe it and say, at what point should a startup approach a venture capital to raise funds?
I like the reframing.
Okay.
So I'll answer the first question quickly and then I'll answer the second one. So, should you decide is a combination of thinking about what kind of founder are you, what kind of team you have, what kind of market you have, how you can scale, how ready you are for responsibility, and whether you can actually sell your business down the line. That is a combination of multiple different things. So, I'll pack that quickly. You need to be the type of founder that is comfortable building with the idea that you have somebody who you're responsible to. If your idea is to own the business for the next 100 years and pass it along to your son, who will pass it along to their son, who will pass it along down several generations, you're not building a business that is going to be backed by a venture capitalist, because they want you to be almost emotionless when about scaling your business. Ironically, even though you always think about how a startup founder thinks about their idea as their baby, their concept, right? Most venture capitalists want you to be less emotional, because only then can you make decisions that are in the benefit of the entire company and the shareholders, not just in the benefit of perhaps that little baby idea that you built. The market potential is super important. If you're building a business that has a guaranteed likelihood that you can scale from one restaurant to 5 restaurants over the next few years, that's great, except no venture capitalist will back your business. Venture capitalists want to know that you're building the type of business that can give them, at the very least, a 1000% return on investment. That seems crazy to imagine. You can never get a 1000% return on investment in most public stocks. Why are venture capitalists saying that? Well, because VCs invest in such early stage businesses, some of those businesses will fail. They will never sell their shares. They will never grow to be successful. Maybe they will even close down because of the high cost of that initial experiment. So, to offset those losses, every venture capitalist says we want a 10x return, or a 20x return, or 50x, which means 1000%, 2000%, or 5000% return among the success stories. So you have to have the type of market that allows you to scale.
Yeah.
You need to have the type of growth that can be scalable, right? You can't be scaling a business that's very asset heavy if there are no big debt investors to give you money. That's why we saw, for example, Move, a Nigerian business, expand to the UAE. They wanted to tap into big debt investors in the UAE and around the world. You need to have the type of responsibility where you can be responsible to external people, maybe people you don't like, maybe people you didn't want to be working for. But as a founder, once you accept money from someone else, you have to come to terms with the fact
Yeah.
that there will be someone who you have to answer to. There's now another parent on the scene, for lack of a better word. And finally, you have to be ready for the exit strategy. For most venture capitalists, because they are not buying a portion of your revenue, they're not buying a portion of your profits, they're buying ownership in your company. They will make money by selling that ownership in your company to somebody else once your company has grown. So most venture capitalists want to know that you have a very ambitious growth strategy. You're in one country today, you'll be in 10 countries in 5 years. You are selling one product today, you'll be selling 100 products in 5 years. You will be growing 10 times, 100 times, a million times the number of customers that you actually have. That kind of growth is what venture capitalists want to see, and they want to see that you're thinking ahead of their benefit. So if you haven't thought ahead of how people will actually make money from investing in your company and then selling that to somebody else, for example, if your startup will be acquired by a bigger corporate, or you'll go public, or you'll go into a merger, then maybe without that exit strategy, you're not a fit for VC funding.
All right.
So now coming to your second question, the time when you're ready is when all of these things align. When you know you're the type of founder that is ready for that commitment, when the market potential is very clear, and it's clear because you've proven it, you've spoken to thousands of customers, you have some paying customers already, the number of customers is growing, so you're good at selling too. You have the type of growth that can scale, like Slack or HubSpot or Salesforce. You can grow from 100 customers to 10,000 without, huge infrastructure constraints. You are ready and responsible to accept external money, and you've thought about how can your investors make money down the line. If
Yeah.
all of this sound like you, then maybe it's the time to speak to some of the VCs
Awesome.
around you.
Awesome. Awesome. Thank you very much. That's very clear. And I would say it's literally like being ready to get into marriage. So you literally have to be committed. Are you ready to be committed? So are you ready for commitment? Have you looked at the potential nature of your market and what you're building? So and you could then decide, okay, this is the time for me to go into funding. I'm ready to be committed. I'm ready to be responsible for whatever funds that will be coming into my company from a third party. Okay, yes, thank you very much, Mark. So far, it's been very insightful. And I think it's time we now talked about your own establishment. You are the co-founder of Dream VC, and you facilitated a couple of funding rounds and everything. So, what is the role? What has Dream VC played a role in towards startup and investors navigate the funding scene?
Yeah, great question. I think in this sense, our answer will perhaps be a little bit different from almost any other investor that might join the tech build tech rounds in the future. And that's
Okay.
because we looked at the tech space, and we looked at the investment space, and we looked at the startup space, and we thought, how can we actually maximize perhaps the multiple of impact that we can accomplish? How can we impact the largest number of people and support the largest number of startups down the line? And the answer to that for us was not traditional. We didn't say, let's put all of our money and invest in startups, which is what angels do. We
Yeah.
didn't say, let's raise money, tens of millions from big institutions and invest in startups. This is what most venture capitalists do. We said, how about we actually go out there and train and professionalize individuals so that then they can invest their money? How can we train individuals who become angels? How can we train venture capitalists so that they can expand and open up offices across Africa or launch new venture capital funds? And how can we train corporates so that those corporates can launch corporate innovation programs, CVC programs, and deploy successfully in African markets? By realizing that, and by actually educating and training and capacity building, that's how we've helped to mobilize by now, these 70 plus funds who are active in market investing in startups, these 170 or so alumni who are now spread across 30 different countries and investing in their local ecosystems, the $6 or so billion that is now deploying towards startups and growth stage businesses across emerging markets. So I think that's our niche. What we do is we provide the necessary glue that keeps the investment ecosystem together and allows us to develop a lot more local investors, Nigerians to invest in Nigeria, Kenyans to invest in Kenya, Egyptians to invest in Egypt, all across the world, so that then there can be a more sustainable long-term investment space. And then in the future, there will be many, many more startups being funded. Side benefit of all of this is if this happens successfully, if what we do works out over the next 10 to 20 years, then actually we won't have to often see the same downturn in funding that we started this conversation with, right? If investors are investing locally, they're getting their money locally, and the entire ecosystem is working together, what happens on a global level won't have as big of a local impact.
All right, thank you very much. Thank you very much, Mark. I see. I like the fact that you explained that as being the glue that keeps both the investors and the startups and maybe angels together, and ensuring that there is cross interplay in the ecosystem. Okay, also with the training, because not everyone wants to train, just want to invest and find your way, and that is very very important. So I think it's time we actually talked about this. You mentioned something about the local investors. So what can be done to bring more local investors into the scene?
Oh, sorry, I thought you almost cut out there. Yeah, so what can be done to bring local investors into the scene? Okay, in Africa or across emerging markets or in general?
Okay, of course, I'm talking about Africa, so Nigeria, Kenya,
Mhm.
South Africa. So how do we encourage? Because, like I said initially when we started this conversation, I said that you see a lot of the times that the funds being raised, the money are coming from abroad. So how can we raise the awareness and
Yeah.
reorientate people so that we have more local investors playing in the tech
Okay.
ecosystem?
Okay, beautiful question. I mean, beautiful question because I couldn't have asked for a better one to explain the significance of obviously what we do, but what a couple of other great organizations do as well. I think it comes down to a couple of things, right? Education and awareness is number one. If people don't know why they're investing, they don't know what they're investing in, and they don't know the significance of that, then trends will come and go. And technology should not be like that. Technology is transforming everything in our lives. In fact, 80 of the 100 biggest businesses alive today are tech companies. No longer is it the case that oil or energy or chemicals rules the world. Technology is very much up on top. So, raising awareness and making sure that any individual that's investing in the space, any individual that becomes an angel, any individual that starts to work for a VC fund, anybody that launches a VC fund, or anybody working within a corporate that is talking about innovation, for example, actually understands why they're doing that with a long term view, that's super, super important as a step one. Without that, we won't really see an informed space that will survive the next 10 to 20 years. Number two is making sure that we stop gatekeeping. Venture capital, if you search up the word, will almost always come up in the same sentence as gatekeeping, as locked out opportunities, exclusive investment opportunities. And that's not correct. Over time, we've seen a lot more individuals that actually have something to offer. A former business development guy, a former marketing guy, somebody maybe who used to be in communications could be very helpful as an investor to an early stage business. But if they don't know about those opportunities, if they have no exposure, then they wouldn't know. And I think something that I've been quite troubled by is that I think at the moment, most African countries are quite behind the global scene in organizing very inclusive, very large conferences around the technology and the investment space. I'd love to see more conferences happening that actually include African ecosystems where anybody could join them and actually take part. But at the moment, there aren't as many of them as I would wish to see, though a few that are perhaps bringing people together, like Africa Arena and GITEX, for example, in Morocco, are definitely taking a step in that direction. Corporate engagement, super, super important. So bringing more individuals into the space also means allowing them to collaborate with corporates. If every single tech guy and every single tech girl is talking about how bringing corporates into the space is going to ruin the opportunity for everyone, we will never engage the established markets. But then you look at the US and a corporation is involved in every fourth investment. Every fourth investment in the US, every fourth dollar going towards a startup has a corporate's name on it. You look at Africa, and it's less than 1 in 1,000 that has a corporate involved. So we don't need to really bring in the corporates into the fold. And finally, it comes back to showcasing that all of this is happening. If you don't know that education and awareness of the investment space is happening through the work of organizations like Dream VC, if you don't know that networking and community building is happening through the organizations like Africa Arena or GITEX or regional summits, if you don't know that governments are putting startup acts into play, if you don't know that corporates are starting to deploy into startups, you will not realize how big that movement actually is, and maybe you won't be motivated to engage. And that's where, the tech media's role really cannot be underplayed. There's a reason why, as soon as Emmanuel suggested, I was saying 100% I want to be taking part in tech rounds. It's because I think the role that tech build, for example, take plays in the ecosystem is super important because you showcase everything that is actually happening, and that raises awareness on a global level. And then people actually know that this is happening. They're not alone, and they can pursue this with greater assuredness in their mind. So, long answer, but education, corporate engagement, networking opportunities, government involvement, and then showcasing that all of this is happening.
All right, that's awesome. Thank you very much. That was really really elaborate. And I think we have another question here. I will just quickly take this one. Let me show it on the screen. So this is from Benga Adeyemi. So what is the chance of transitioning? I think that's meant transitioning from data analytics and science to VC field. Can it be done? And is there any history of anyone who has successfully transformed or transitioned? So this is like a switch in career.
Absolutely. Absolutely. Very good question. Thank you for asking that. In fact, I am perhaps a little bit unorthodox in the sense that I believe that you can transition from almost any career into the venture capital field if you do it right. If you do it wrong, no matter what background you have, you might not be a good asset to the venture capital space. But if you do it right, if you come in thinking about how you can add value first, how you can help somebody else first before you help yourself, then in theory, almost any background could be helpful. Let me focus in on the data analytics and science point. Have there been people who've come from, for example, data science in a corporate background to then join VC funds? Yes, there have. In the US, especially, you see a lot of individuals who used to be a quantitative background, work at quantitative funds, hedge funds, or, for example, on the data science side of big banks, who then use that experience, use the fact that they're very good with numbers to transition into the investment teams of venture capital funds, especially those at a later stage, who need perhaps that detail orientedness, the ability to manipulate data, the ability to extract from that data, and then use that to inform an investment decision. Has it been done by people to launch funds? Yes. In fact, I've seen at least one or two fund managers on a global level who've come from a former academic career in data analytics to then actually transition into saying, look, I have a network of people who are also quite interested in the space. I have a very quantifiable reason for why I want to invest in this space. Here is reason A, B, and C. If I can raise money from my network, I can invest. And that's exactly what they've done. And sometimes investing even in very, very crazy innovations, right? In engineering technology, space technology, transport on a new level, like hovercrafts. So can it be done? Yes. Is there history of anyone who's successfully transitioned? Yes. But do you want particular examples of people who've done that on a local space? Well, the easiest person to answer that wouldn't be me. That would be LinkedIn. Search up for someone with data analytics background now in the venture capital industry, and I guarantee you, you'll find at least 100 people in the space today.
All right, thank you very much. So there are people that have done them, that have transitioned. Okay, so it's all about the intention. If you're intentional about what you really want to do, then there's no fear going into that. Okay, we have another one here from Regan Kuto Simakoko says, "Thank you, Mark." So, Mark, that's to you. Those are people applauding your insight, and it says, goes on to say, well trained, knowledgeable VCs are so very needed in the local African startup ecosystem. Yeah, so you see, that is what I'm saying. We really need people to come in locally to drive the innovation in Africa. So, thank you very much. Thank you very much. And all right, so this is still tech round. So if you're still joining us, just know that you can join the conversation and bring up your points too. And to the next question, Mark. So once the investment is made, how does the relationship between a startup and a venture capital firm typically evolve? And do the expectations also change? Because I would also like, when you were answering these questions, you also consider the fact that some startup really need to know beforehand what they are going into, or what kind of relationship they are going into with this particular venture capital firm they're raising funds from, because at the end of the day some are like, why did I even go into this? So Okay, you can go on with that question, Mark, if you're ready.
Absolutely. And I think, Emmanuel, I'm going to piggyback off something that you said because you're actually not the first person to use that analogy, and it's a very good one. Thinking about creating a startup that raises money from venture capitalists is a pretty big life decision. But actually, raising money from venture capitalists is almost as big of a life decision as getting married. You're signing legally binding documents that will ensure that this person who you've raised money from might be in touch with you over the next 5 to 10 years. In fact, that's longer than some marriages last. So, with that in mind, you have to be prepared for the fact that that relationship will naturally evolve as you get to know each other better, as they get to know you better as a person, as they get to know your company better as a person, that investors who is giving you money, but also that it could evolve in a good direction or in a bad direction. What does that mean? A good directional evolution is when a startup is doing very well, or even not doing very well, but communicating very transparently with investors. Communication is frequent on a weekly or monthly basis. The investors and the founders share the same expectation of how that communication will happen over WhatsApp or an investor update over email, whatever else the communication format is. And I've seen some VCs and the startups they invest in become very, very close friends. I mean, I'm no exception to this. A lot of the founders that I invested in before, I was invited to their marriages. I was invited to their name days. I've been to personal events with them because over many years we've come to know each other very well. And when they need something personally, even if it's not related to the company, I will help them. And if I need something personally, often they will help me as well. That's the ideal scenario. The worst scenario is where the expectations are not aligned. So maybe you raise money today thinking that, look, your only role as a founder is to grow this business and return the investor money. And in some cases, investors are happy with that. But other investors might want to be involved. And if they want to be involved and you're shutting them out, that's like a marriage where you came in expecting that it's going to be a loving partnership and then you're never around, right? That's not going to last. So, with that in mind, you often see that perhaps the evolution trends to a slightly less than positive one because the expectations are starting from a financial point and then can evolve into a very negative conversation if the founder then says, well, you know what, after raising money from you, I have gone and bought myself a Lamborghini, or I have gone and moved to the US, and it doesn't feel like building the startup is as much of a priority for me. For the investor, they've gone and told their own firm, they've convinced multiple people that they should invest in you. And if you don't reciprocate that, then that becomes a problem. So I think the relationship can evolve in different ways. Usually it evolves with a certain maturity from both parties, a certain acceptance that you need to rely on each other, and the comfort of being able to ask for help. And I think the ideal relationships I've seen from even other venture capitalists is a point where, let's say you're a founder, you've raised money from this VC in year one. 5 years later, you know each other very well professionally and maybe even personally. And if you as a founder then sell your business and launch a second one, you have a good enough relationship that you can go back to the same VCs and say, look, I made you money before, let's talk again. And they will give you the honor and the respect to listen out to your idea, even if you have no proven idea yet, and potentially invest in that business even earlier. That's why you see founders who respect their investors and investors who respect their founders and have that good relationship often carry that relationship through time and time and time again. So if you look at a second time founder, third time founder, often their investors will be the same ones as they had in the first startup because they were smart with that relationship.
All right, all right. Thank you very much. That's really interesting. So, um, I'm very sure that any startup who is listening to this would really get clues on how to go around this sort of activities. So thank you very much. It's been really, really interesting here on Tech Rounds, up from the topical conversations and everything. I would really thank everyone. And I think we have some. I'll just go on. I don't want to leave any message on red here. I'll just go around again and thank you for your insights, Mark. That was from Ogenyi. We have Wale Oguntokun here. Says, well done. This is highly informative. Thank you. Thank you very much, Wale, for that one. And yeah, it's been really interesting. So, and I think we're going to wrap it up on this session. We normally have two segments. So, we've done justice to this first one, and the second one is all about Mark, and we get to get like up and close with you, Mark. So I hope you're ready for this one, though.
Well, not as ready as the professional one, but let's give it a shot.
All right, let's do this. So the first one: what's the one piece of technology that doesn't exist yet, but you wish it did?
Hmm. Maybe a solution to traffic. I think there's definitely some technology that exists in the space, but it doesn't seem like the technology is as good as it could be. I am always someone who is quite impatient. I travel around a lot. I spend, maybe 20, 30 flights a year when I'm traveling from point A to point B. And so for me, the one thing that I hate the most is losing precious time that could be spent with people you want to speak to, people you want to collaborate
Yeah.
with. And unfortunately, some of the biggest losses of time are spent in Cairo traffic, in Lagos traffic, and a
Welcome
few
to
other places
Lagos.
around. It is. It's the case. It's just unfortunately something that's unavoidable. But my question is it actually unavoidable? I think startups always try to deal with a problem where the bigger the problem, the more frequent the problem, the more painful the problem, and the more people are willing to fix that problem, the more the market for the startup. So it just seems to me like this is a great opportunity. Whoever can invent some way of vertical travel,
Yeah.
hovercrafts,
Yeah.
something that will help to cure traffic in some sense, or
That,
at
that that
least
would be an
maybe even
awesome innovation,
non-traditional.
actually. I'm actually thinking, but
Isn't it?
that
Yeah.
would be a big one, because you really need to talk about start to have conversations about the routes, about the forms of transportation, and a lot of construction.
Absolutely. I mean, whether it's asset heavy, like a new type of transport, or whether it's asset light, right? Like a
Okay.
very smart city, for example, layout where you play around with traffic lights and directions so that when there's congestion on one street, you actually route people through those smaller streets.
Oh,
That already happens, but it happens manually. Why is that not happening institutionally? We have so many smart engineers around the world. Why hasn't someone created a map
awesome.
that maps out using a satellite, a city, and allows you to avoid traffic wherever you go? In theory, that can exist. So when
That's
someone does,
awesome.
definitely give me a shout.
Or maybe we could explore the route of teleporting, and you just have to like take off.
Yeah. Hey, if you hear about anyone building a teleportation machine, I am a very happy listener.
I'm sure you'd be glad to invest in that startup, right?
Sure. Just give me a shout and we'll gather up some
All
scientific
right.
investors and we'll put
Let's see
something
how
together.
that goes. All right, to the second one. Can you share the funniest or most unexpected pitch you've ever received?
Wow. Funniest or most unexpected pitch? Hmm. Well, I've seen a lot of crazy ones. I've seen flying Hoovers, which I don't think are actually as crazy now as it used to be. I've seen just robotic Hoovers now all around the world, vacuum cleaners. I've seen crazy ideas for somehow extending your life. I saw a lot of investors
Wow.
in the US backing ideas to extend your life past 100 years, which I think is a little bit strange and almost a dystopian. But I think the one I'll use is perhaps something a little bit more down to earth. There was someone who pitched me a few years ago. It was not just me. I was there with a couple of other friendly investors, and I can't remember how they got into the room with us, but I always try to be accessible to people, and maybe they had my WhatsApp, and they said, "Okay, let's set up a call." So I set up a call and got some other investors with me to listen to this idea. They had all the right background. I think Stanford dropouts, good experience, wealthy background. Some other angel investors had given them money already, and they said they were building in the education space. And I think there's a lot that can be done in the education space. So I came to listen. What was their idea? Well, their idea was they said, how about we give young professionals, young people who are under 18 in the United States, an amazing opportunity to build work experience? We will plug them into tangible roles, into gaps into the economy. They can serve as cleaners, they can serve as hotel staff, they can serve and support the police, they can support in other roles, maybe even programmers. And then this will be great professional experience for them before they are able to go out there and work. And at the same time, for the companies, this is a great cost saving. Instead of maybe giving out and spending several thousands of dollars to employ someone full staff, what if instead you paid this platform something to connect you to some eager young people who want to work for you for free? And then you just pay them a subscription fee. So I was listening to this and I was thinking, okay, it seems to make sense. And then I thought about it for a second and I was thinking, wait a second. You're just saying that these young people are going to work for
For
free.
free.
You're going to sign
Wow.
them up to work for free, do nothing for somebody else, and then you're actually charging that somebody else. So somebody else is still paying you to basically redirect free labor.
Isn't
Either
that
they've
modern slavery
reinvented,
though?
I mean, either you've reinvented the typical emerging market family where your parents just say, hey, go and do work, and you have no two ways around it, and you don't get paid, or this is modern slavery. If it's the first, then this is not innovative in any sense. If it's the second, then I'm pretty sure it's illegal. And I remember when I asked them, hey, aren't you employing like a 12-year-old as a cleaner? Isn't this illegal? They said, most crazy innovations are on the gray line between legal and illegal. I don't think this is a gray line at all. I think it's a black line. You're building something that's illegal. So in that case, I obviously didn't continue the
That one
conversation,
is
and
really
I don't
crazy.
know if
That one is
they.
really crazy. It's what it, it's what being crazy. Okay. The third one. So outside, I know we have some questions. I'm going to read those questions. So let's just finish with this segment, and I'll read out those questions before we go. And outside the world of venture capital and startups, what's your hobby or activity that you're passionate about?
Hmm. Well, something that most people will know is they'll know I love traveling. If I
Okay.
didn't love traveling, doing what we do, working all across Africa, convening investors, sometimes investing in startups myself, traveling around would be a big bother. But because I enjoy it, because I really love travel and I enjoy trying new foods, for example, for me, that keeps me on my toes and allows me to do something I enjoy while also doing my day to day. Something that people maybe don't know is that I also love hippos. I don't know where this stems from. At some point as a kid, I think I was very impressed by a hippopotamus in the zoo. And ever since then, I've just had a great respect for hippo.
Oh,
So I collect hippo statuettes. I travel around and try and see them in the wild. And I think, as compared to every other animal that I would probably run away from, it's one of the few dangerous beasts that I'm quite fascinated about.
well,
So yeah, that's really.
that's cool. All right. So speaking of, you said you like trying new food. Would you prefer continental or local dishes?
I mean, I think when you're traveling, it's part of respecting the local culture to try local foods. I think
Okay.
I always found it very weird when some of my international friends might travel from the US to Nigeria or Kenya and go to a McDonald's. You can go and find that McDonald's back home, right? If you're traveling somewhere, you should be trying,
Yeah,
suya,
to
you should be trying
explore
local
and blend
jollof, you
in.
should be trying local food. Exactly. Like, I mean, I've never seen snail offered on a single dish anywhere in Europe. And then I came to Nigeria and multiple times, and I've had snail, and I actually really enjoyed it. I've never had goat pepper stew before I came to Nigeria,
Mm,
right? I've never had various types of samosas before I went to Kenya. I've never had, for example, particular types of, I think, wild ram or whatnot before I went to South Africa. And just recently, I came back from Japan. I've never really been a big fan of raw food, but when I was in Japan, of course, I would try
you really
sushi and
have.
whatnot. I mean, who
So
wouldn't,
how
right?
about
So
Nigeria? Have you tried the stuff like amala, egusi, afang soup, ekpankukwo? I don't know if you've ever heard of those before.
yes, I have, but I'm not big on swallow food. I'm big on something I can chew. So if
Oh,
it's something I can chew, I like it. If it's something I can't chew, it's still a little bit strange to me.
all
But I
right.
have tried all of them.
All right, that's fine. That's fine. But so if you weren't in venture capital, what completely different career path do you think you might have pursued?
Hmm. What completely career
Is that a
different
tough
path
word
would I
for you?
pursue? Well, yeah, well, I think before venture capital, I was very passionate about consulting initially because I thought that consulting was all about solving other people's problems. So if
Okay.
you don't know what you should be doing with your life, it's a very easy transition to think, well, if you solve other people's problems, you're doing something kind of good for yourself and good for other people as well. So I really used to enjoy that.
All right.
I think beyond that, I always thought and had the greatest respect for entrepreneurs. I think if you have a great idea, if you want to drop better opportunities to go and build something that's genuinely disruptive, that will genuinely improve the lives of people, businesses, and organizations all around you, it's almost like a social obligation that you have to go and pursue that skill set that you have. So if I had a great opportunity, maybe I would have been an entrepreneur. But for now, I think venture capital became open to me, perhaps, and I've been happy to pursue that, and I've been happy to stay in the space. So maybe I'm not no longer managing a VC fund as I used to in the last few years, but managing Dream VC has proven to be just as informative and perhaps even more satisfying
All right. All right.
to
Thank you
my day
very
to day.
much. Thank you very much. So the last one, what big tech trend are we going to be looking at in the next 5 to 10 years? Let's say in a decade's time. What's the next big tech trend that we will be talking about?
Well, I certainly don't think AI will go away. That's a starter. So I think
AI.
the thing with AI, many people have been saying, oh, it's, another Web3 boom, or it's another crypto boom, or people are jumping onto the next big thing. That might be true, but I don't think it's true because every indication that I see suggests that, for example, artificial intelligence in general is just the tip of a broader set of technologies. And those technologies will eventually become more commercially available. And we will start to see large language models and the whole essentially digitization of industries at a large scale,
Yeah.
almost as disruptively as we saw the internet and how it affected day-to-day lives back at the turn of the 2000s.
Yeah.
But what new technology? I think for me, I'm very, very clear on the fact that climate tech has a unprecedented role in the next 10 years. I
Yeah.
think people have been talking about climate for the longest time, and
Yeah.
I
Very
mean, I
true.
should know.
Very true.
I studied economics and geography, and in geography, everyone was talking about how, look, we are getting past the point of no return. The global temperature is rising. You see an increasing amount of extreme events all around the world, and it's now gotten to a point where anybody, even in a rural settlement around the world, can say, look, something is going wrong with climate, right?
Yeah.
That's something that almost everyone can agree with.
I
Now,
think
if you agree with that
climate
idea,
action innovation are really going to come up a lot in the future times.
and they are, right? I mean, I think the biggest proof of this is most VCs invest in something that's on the cusp of becoming big, right? Because
Mm.
we invest in the top end of innovation. And the sector that I've seen growing the most, that's been the most unexpected, was not AI or Web3 or something else, was climate.
Yeah.
I've seen a number of different people launch climate funds, climate venture builders, start building climate startups now. So those ideas that are starting now will become very big in 5 years and will become the talking point in 10 years.
Would you be
So
willing to
hopefully by
invest
that point,
in this sector?
absolutely. Do I invest or do I know people?
You would you be willing to invest in this sector?
Yes. No, yes, absolutely. If it's something that I can relate to and I can help with, then absolutely. I think for me, I have a very open investment mandate as an individual. As Dream VC, we don't institutionally invest anymore, but as an individual, I've invested in startups in Nigeria, in Kenya, in Ghana, in Rwanda, in Cameroon, in South Africa, etc. And I think for me, it's always a question of, okay, do I understand what they're building? Do I think this is super scalable? Do I think this founder has what it takes? But secondly, can I actually help? Right? If I can't genuinely help this business to grow from point A to point B, why should I be investing in this business? They should find a better investor for them that can actually be more involved.
All
And I
right.
think for some climate topics, maybe I'm not the best person to help them, but for others, if it's in my area of expertise, 100%,
All right. Thank you
100%.
very much. Thank you very much. Speaking about climate action, Climate Action Africa, it's going to have the CAF 24 event in June. I think that's June. So you can check on our website for more information. Tech Build Africa. You will see more information, and then it's an international conference. We'll have people all around the world, different innovators in the climate action space coming around for that one. So that's just a quick one there. And thank you very much, Mark. That's the end of that particular segment about you up and close with Mark. Good to know some few things about you. You're not so. It could be very easy to say that VCs are very boring, but I don't see that in you though, and that's fine. I'll just go back to the comment section, and I have this one. Okay, thank you very much, Mark. Thank you very much. Okay, and we have Abdul Malik. I think LOL teleportation. So that's when I mentioned about the teleportation stuff when we talked about the uh, ideas for dealing with traffic. So it was laughing out loud on that one, Abdul Malik. And then we have another one here from Abdul Malik. So I want to ask Mark a question. Are there any current VC funding that he knows of that are funding AI startups? Okay, in Africa. So that's another question from him there. And then from Edgar O'Day, he says, "Hi, Mark. Are you looking to invest in Nigerian startups?" And the last one is, "Thank you, Mark, for trying out local dishes." I'm hoping you will keep trying local dishes. So let's start from the one from Abdul. I think that's Abdul.
All right. I think the question was, are there any current VC funds that I know of that are funding AI startups in Africa?
Yeah.
I will turn that question on its head and be very unhelpful. I would say there's almost no VC fund that isn't funding AI startups in Africa. The vast majority of VC funds are very, very sensitive to trends, and the entrance of the AI scene is unavoidable. I don't know, Abdul Malik, if you know, but actually just this year alone, we had some very major transactions just in the last 12 months or so. Several very major success stories in Africa of AI businesses like Expensia and InstaDeep, for example, from Tunisia, both of which were acquired for more than $100 million. So for every VC in the ecosystem, as soon as they heard that, that sent alarm bells ringing. Why are we not investing enough in AI? So I've been around, I think, 12 countries in the last 5 or 6 weeks or so, because we were organizing a number of investor events to bring more people into African focused investing. And in every single room, there were people talking about investing in Africa. Take any generalist African fund, and they will be open to investing in AI. That's number one. Now, if you're building something that's very nuanced or very technical in AI, it's a little bit different, because then you need to target a specialist investor. And there are specialist investors who target the AI sector. Normally, they're called deep tech investors because they have deep scientific knowledge and they are investing in sectors which are yet unproven without necessarily a proven market opportunity, but which might be very, very successful. A couple of ones I'd love to give a shout out to include, for example, Savant Venture Capital, a fund out of South Africa. They've been doing this for close to 20 years and definitely are one of the foremost deep tech investors in Africa. Secondly, Titan Seed Fund out of Tunisia. It was set up on the back of the recent Tunisian success stories and has some very strong investors backing that as well. And thirdly, Modus Capital out of the UAE, but with a focus on Africa. All three of these are specialists at deep tech investment, and especially love to see AI startups that are doing something really innovative. So target any three of those, and I think you're likely to get a warm reception.
All right. All right. Thank you very much. And that's one. Then the other question was, are you looking to invest in Nigerian startups? I think that you basically said that in your conversation. So do you still want to add something to that?
I mean, simple answer is yes. I mean, I'm looking to invest in general startups. I think I don't invest as much myself as an individual, as I explained earlier. Now our role is much more so in catalyzing other people to invest. But I would say a good 30 to 40% of all the investors we ever trained have Nigeria as one of their biggest markets, right? So think about it in this way: out of the close to 200 people that are now working at funds, running angel networks, or investing in startups, probably more than a quarter, if not more than a third, are saying that they want to actively invest in Nigerian startups. So individually, yes. Institutionally, through our network, yes. It's really all about just targeting the right people with the right proposition, right? If
All
you're
right.
looking at building a Nigerian health tech startup, target an investor with experience in health tech. If you're building a fintech startup, target an investor with experience in fintech. It really comes down to building that strong relationship that Emmanuel alluded to earlier.
All right. Thank you very much. So I think that addresses all the questions that we've had out so far. I don't know how to say this though, but it's been really, really insightful here on Tech Rounds, and I'm very happy to have had this conversation with you. And it's time that we draw the curtains for this particular one. And I want to give a very big shout out to Mark for finding out time to have this conversation with us. And we hope to maybe in future time have another session like this where we get to throw more insights about different sectors of the tech ecosystem. So thank you very much, Mark. Your last, do you have any last thoughts before we draw the curtains for this session?
I think my last thought is always consider investing in yourself first, right? If you don't invest first in yourself, then how could you think about investing in somebody else? If you want to really engage with the startup ecosystem, you want to work with the technology space, you want to see how you can play a role in the evolution of the sector, it's really important that you do so knowing about the risks involved, but also the opportunities, so then you can be more successful. Obviously, a part of that, if you are thinking to join as an investor, is something we can help you with, right? If you're interested in emerging markets in Africa in particular as an investor, uh, go to Dream VC, search up Dream VC online. You'll find our website. You'll find lots of information. So you can download lots of free material we put out or even join one of our training programs. In the other hand, if you want to invest in something else, make sure you read about it first. I think the biggest, damage we can do to the ecosystem is if we invest without knowing what we're doing with our time and our money. So before you make a decision, always invest in yourself first, upskill yourself, build your network, build your connections, surround yourself with smart people, and then any decision you make will be more likely to be successful. Other than that, I guess the one thing is, would love to stay in touch with everyone as well. So if anyone wants to keep in touch with me from following the session, please feel free to follow Dream VC online or just find me online on any social media. I'm most active on LinkedIn at just my first name and last name at Mark Kleyner. So yeah, thank you everyone for jumping on and for giving me the chance to share on this particular interview.
And thank you
All
very
right.
much, Mark. It's been a nice one. We already out of we have some technicalities here to fix. So thank you very much for joining for this session. For every other person who still wants to connect with Mark, you can find him on LinkedIn or you can reach out to us on TechBuild Africa on every platform and then we can always connect you. But do well to subscribe to our platform on YouTube, on LinkedIn, and every other place. Subscribe to TechBuild Africa. Join our community on Telegram. We have opportunities we share and stories and everything just about technology and the African innovation and how we can collaborate and create magic in this ecosystem. So thank you very much. And just know that on Thursday, we are having the co-convener of the Omniverse events live on Tech Round. So let's make it a date. Let's come out and join that conversation. Thank you very much, Mark. Do have a very lovely day.
Thank you for having me.
All right. Bye.